Catherine Magaña here with Rachel Ivanovich and Vince Stefano, where we're here to provide you insights on the markets, planning, and much more. So here we are. Today is September 25th, and we're still hearing about the Fed. So last week, the Fed cut rates, and it seems like that's just the headline that I'm seeing everywhere these days is what's the Fed going to do? And it looks like there's some differences of opinion. But long story short, I thought I'd start off by giving you kind of an update of the probability of where we're at with the Fed watch for a rate cut, which the next meetings, or this isn't going to happen until end of next month, but it looks like right now we're at about 85.5% probability of another rate cut. And obviously we still have a few more meetings between now and the end of the year, but it just seems like that the Fed has been the highlight all year long. Also looking at where we're at with mortgage rates. So mortgage rates right now, the 30-year is at about 6.33, which is actually up slightly from last week. It's up 0.10. And the 15-year is at 5.66, and that's up 0.22 from last week. But interesting, when you look at the existing home sales, the report that came out basically said there was a surge in month over month in August that for home sales surged 20.5%. So that's kind of interesting. And I recently we heard somebody that I know that does mortgages, and she was saying she's just getting bombarded right now with people wanting to buy homes. And it seems like with some of the rate changes recently that some of those that were sitting on the sidelines are now wanting to buy, at least some first-time home buyers. And I know, Rachel, you were sharing that you have some of your family members that are looking.
Yeah, absolutely. I have two young kids that I'm really excited because a lot of 20-year-olds I've heard, they've given up on the American dream and think they'll never buy a home. And now both of my kids are, getting pre-qualified to buy homes. So
where?
In Boston, and which is not cheap.
It's not cheap.
It's not cheap.
Boston's not a cheap city.
And in Seattle, not Seattle, Spokane, which is less expensive.
Less expensive.
Yes,
Yeah,
definitely.
And then I also have another client I'm talking with right now, and she's looking at a place in North Carolina. And so she's looking at moving out of state. Originally, she was looking at the beginning of next year, but it looks like the values came down a little bit and with rates, and so it looks like she's going to.
Well, we were just at a real estate conference randomly, and they were saying with the rates coming down, a lot of people who want to put their house up for sale now. I mean, they love their rate.
Low rate.
Yeah, they love the low rate, but don't love the house. So now that rates are coming down, they can, sell and get something else.
Well, I think prices have come down.
I think there'll be more
also,
inventory.
So that helps a lot.
Yeah.
Prices have come down. Rates have come down. So,
gives people a chance.
People are
there you go. People are waiting. Now's a good time. Jump in.
Yep. Some other numbers that came out. So the August durable orders report grew by 2.9% month over month, which was better than expected. I think expected was supposed to be negative 0.3. And so the winners were the transportation was a big winner, rising 7.9%. And then aircraft spending rose with defense aircrafts and parts booming 50.1%. So that was kind of interesting to see that come out. And then another report that came out was consumer spending was revised to 2.5%. It actually was revised from 2.5% from 1.6%. So it looks like obviously consumers are continuing to spend, and which is kind of interesting. But before we move on, I thought I'd give you a quick update where we're at with the markets. So the Dow Jones year to date as of yesterday's close, so as of September 24th, the Dow Jones was at 8.41%, the NASDAQ at 16.5%, and the S&P 500 at 12.86%. So it's interesting. Here we are, we're wrapping up the end of September. The markets have been up, but it's also been pulling back these last few days.
Yeah, and we've been talking about September.
Right? I know, as I look at you, I'm like, Vince, what do you have to say?
I've been talking.
Although we're not done yet. So.
That's right. We've got 3.5 more trading days left, so you never know. But September, I've said, is a volatile month. Once again, mutual funds are starting to sell to reap their capital gains so they can pass them on to their investors. And oftentimes you get some big swings in the market. But I do want to touch on another. You had mentioned rates and other things. Mm-hmm. Today there was a second quarter GDP revision came out. Yep. And the number came out at plus 3.8%, where the previous number was at 3.3. So, that was interesting because it looks like the economy is doing quite well. Jobless claims are down, which kind of interesting, a lot of the talking heads came out and immediately said that it works against 2 more rate cuts by the Fed. But your number, I think it was 85%?
85%.
Yeah.
Another cut next month.
Yeah, and I don't know if you had a December number.
I don't. I have heard that there's indications of 2 rate cuts, but I don't have the probability of that.
And again, I don't know what you never know what the Fed's going to do, but I think they're going to continue to cut rates, even though this number is a little bit higher than they would like it to be. And the market sold off very hard initially off that, but it's been rallying back all morning. So, by the dip mentality, I don't know. But what's interesting, we talk about stocks, we talk about people investing in the markets. What I read something where so far through this year, through mid-September, foreign ownership of U.S. equities, they own 19% of U.S. equities.
Interesting.
So that's pretty high.
Pretty high.
Share repurchases by companies. We talk about that. Over 800 billion so far year to date of share repurchase. What also is kind of interesting with the Fed cutting rates recently, I did see that money market funds hold over 7.7 trillion. And that's with a T, not with a B.
Yeah.
I'm talking trillions of dollars are sitting in money market funds. Now,
and speaking of money market funds, I looked at some of the short-term rates, and even money market rates, the fund rates have come down.
Yeah.
So we're not getting those higher rates. And then even CD rates right now for 1 year is 3.75, and U.S. Treasuries for 1 year at 3.76. So you're starting to see those shorter, and
and we've been talking
income.
about this as rates come down. What do they do? They move people into more risk assets like stocks. But the article that I read, and it was kind of interesting, people that are over 55 feel very comfortable keeping their money in money market funds, even if they're getting a very low return. They would rather keep their money there. Now, granted, I don't know what their situation is because they quote somebody, and they say, "Oh, I want to keep my money in money market funds." The big issue I have with that is that the more and more decline you see in these yields, when you X out taxes, when you X out possible fees that you're paying, the overall return is not very high. So again, I think you have to be very cautious when keeping too much money in money market funds or very low yielding CDs. So, if we get the 2 more rate cuts between now and the end of the year, I think that the market is going to respond very nicely to that. And also, 9 to 12 months out from 2 rate cuts, the markets are typically up very wise, usually over 15 to 20%. So again, if you're sitting in low yielding money market funds, you may, not get the appreciation you want in your portfolio. So be very careful.
Yeah, it's interesting because we've had several clients recently were having those conversations, and once again, when rates were a little higher, they felt comfortable, but they're now starting to say, okay, let's put my money to work, or they realize I have my emergency money set aside 3 to 6 months potentially. Now I'm okay with making sure my money is working for me. And it doesn't always have to be stocks. It could be bonds or other income-generating investments. But there are a lot of different options that are out there. But we are seeing that shift. And also I'm reading articles that there is money moving out of money market funds.
Yeah, I'm not a bond manager. I don't want to be.
Yeah.
But, you guys do a lot of financial planning. And I guess the question I have is if rates are coming down, obviously, longer-term bond prices will appreciate with the inverse relationship. So how many people are thinking, let's put money into longer-term bond funds? Are you hearing that?
It's kind of case by case if it's bond funds or individual bonds. So we do have a ladder of bond portfolios, 1 to 10 years. There's corporate bonds. We also have municipal bonds, depending on the tax bracket. So usually there's the short term, and then you have a little bit longer term or intermediate term bonds. So it's just figuring out where's the best place. And then occasionally there might be some clients in bond funds, depending on how much we're allocating or investing in. The bond funds, we don't have as much control because you're pulled in with other investors. But bond funds, there are different levels of bond funds or short-term, intermediate, and long-term bond funds. So it just depends on kind of how much we're working with, what's the overall plan and strategy, and how much do we have allocated.
Well, the reason I ask that is because if rates come down, obviously those bond portfolios are going to appreciate.
Yep.
And if you get appreciation in your bond portfolio and your stock portfolio, boy, that's pretty nice. I mean, that doesn't happen all the time. So again, I just say to anybody out there, be cautious when rates are coming down, not keeping too much money in money funds. And one other thing I want to touch on, you had mentioned mortgage rates. And Treasury Secretary Bessent was out the other day in an interview, and they asked him some stuff, and he said he's not concerned about a recession in the United States, but he is concerned about working Americans being hit hard by high mortgage rates. So it's kind of interesting that you just mentioned that rates are coming down, and that's one of his issues right now. Is that he wants mortgage rates to come down even further. So
I think there's still a lot of people on the sidelines, even waiting even for it to come down even further. And like Rachel mentioned, we were at this conference, and they're saying that 5.8% approximately is where
that's the magic number.
That's the magic number. You'll see a lot of movement if we get down there. But we're a little ways from there. But as things change and evolve, we'll definitely keep you up to date. But I thought I'd share with you. I know Steve's not here today, but I thought I'd share with you the Fear and Greed Index.
Oh, here we go.
And so here we are. I actually looked at this yesterday. So yesterday was September 24th, and the index was at 57, which was actually the tail end of greed. And as of today, we're at 52, which is neutral. So I kind of also, we've been seeing the markets pull back a little bit the last few days. So I just thought that was kind of interesting that literally overnight we saw a big change from greed to neutral.
I think a lot of people haven't filed their taxes yet. There you go. And they're waiting to see if they owe any more money or not. Because we are, okay, so let me jump in.
There we go. Taxes.
Yes, taxes. Well, you were talking about being cautious. So I, of course, was thinking about taxes and how we had a lot of surprises this year because a lot of people did have their money invested in high-yielding CDs or money markets.
And
there was a lot of interest income that they hadn't had in the past, and that triggered higher taxes, and they weren't planning for it. They hadn't told me about it. They hadn't told our team about it. So always be planning ahead for your taxes and for your investment income, working together with your CPA and your financial advisor so that you are planning for those and don't have any unexpected surprises. So the trust tax deadline is in 5 days. It's completely random. September 30th is, that's the last day to file your estate or trust return for 2024. And then we have 20 more days of the 2024 filing season for individuals.
It's so interesting that we're like at the end of we're approaching the fourth quarter. We're approaching fourth quarter in 2025, and you're still in 2024.
I'm still in 24. I've always said, last 25 years, I'm always a year behind. Yeah. And so had a really interesting situation with a client. Haven't quite resolved it yet, but I wanted to talk a little bit about revocable and irrevocable trusts and, a situation that came up. So I had a client call in and said, her mom had just passed away, wanted to know, what she needed to do, and did she need to get an appraisal on the house that her mom had owned in her mom's trust. And then I said, well, I think the house was in an irrevocable trust, which means you don't get the stepped-up basis. And she kind of went completely silent. And so I think it's really important for people to understand the implications of putting assets into an irrevocable trust. And so just let's touch on kind of the key differences. So with a revocable trust, the tax implications. So there's no estate tax savings. And basically with a revocable trust, you don't have any immediate tax benefits. The assets remain as part of the grantor's taxable estate. So the grantor is the person who started the trust. And a revocable trust uses the grantor's social security number. So by contrast, irrevocable trusts, they remove those assets from the grantor's taxable estate and they provide a potential estate tax savings. But if you have that irrevocable trust, unfortunately, you don't get the step up in basis, meaning whatever you bought the asset for when person passes away, the beneficiary then can use as their investment price whatever that fair market value was the day that the person passed away. So going back to the situation with the client, the house was purchased back in the 70s for $30,000, now is worth over $1 million. So had it been in a revocable trust, it would have basically bumped up to $1 million, the basis, meaning if they had turned around and sold it, and right now, there'd be no tax due. Mm-hmm. Irrevocable trust, if you transfer that asset into that irrevocable trust, now all of a sudden, there's $700,000 worth of taxable gain. So make sure you're talking with your estate planning attorney, talk
and
to
then
your
read
CPA.
the details, because you may start with a revocable, and if it turns into
Correct.
irrevocable, that's where this can trigger.
And typically what happens with a revocable or living trust is oftentimes is referred to as a living trust, because you're living and you still have control over the assets in that. Sorry, I just lost my train of thought there, but you've got to be really careful with what you're doing and make sure that you're doing your planning ahead of time. The other thing is sometimes what happens with that irrevocable trust is people will put their assets into an irrevocable trust because they want their parents to be eligible for long-term care benefits or Medicaid, and there is a 5-year look-back period on that, so you need to be planning way in advance for that if that's your goal.
And then as you're talking about trust and how things are set up, we do occasionally meet with clients and they have a trust, but then when we're going through their investments and their assets and their savings and they have a lot of money in different accounts, then what we realize is sometimes the accounts aren't titled in the trust.
Just listed.
It's just listed, and when it's listed, I think
In the
sometimes
trust document,
and you think, oh, it's in the trust,
Yeah,
but the
but
reality
it's
is
not.
if it's not titled properly. So once again, talk with your estate planning attorney, consult with us. I mean, we're here to help you, guide you, make sure you're
And a
making
lot
the
of
right
estate
decisions.
planning attorneys, as you're setting up your trust,
They'll
will
help
help
you,
you
yeah, to
to
retitle
make that,
things.
with the retitling, but you need to make sure you've done that. So just be careful. And know the differences between the two because it can be a huge tax savings or a detriment down the line.
Volatile taxes, volatile market.
There you go.
Here you go.
Well, it's life in general.
That's right.
There's always something going on. So right now we're towards the end of September, and we are gearing up to make sure that our clients have taken their required minimum distributions. So if you haven't, you'll be hearing from our service team. If you're a client of ours, we're sending out letters and notices to make sure that this is done between now and the end of the year. And so with required minimum distributions, which we've talked about a few times, but it's interesting, some clients aren't aware, especially if they've never taken distributions before, you can do what's called a qualified charitable distribution. Do you want to chime in on that, Rachel?
Sure. Sure, I'd love to. So actually, if you're over 70 and a half, you can do a qualified charitable distribution. What that means, it's a way to reduce your taxable income, but also satisfy your required minimum distribution. So the way it works is you work with us and let us know, I want some of my money to go to a charity. And it oftentimes is really good because of the higher standard deduction. A lot of people aren't itemizing their deductions anymore. So you can send money directly from your IRA directly to your charity of choice. You don't include that in your taxable income. The charity gets full benefit of the money, and you have satisfied your required minimum, and you don't have to include it in income. And with some really good planning, because keep in mind, Social Security benefits are taxable based on your other income. So there's typically just work with your tax advisor, work with us. We're happy to help you reduce your taxes in any way we can.
And I'm assuming it's a dollar-to-dollar write-off when you do it from an RMD, a charitable.
Correct. It reduces your taxable income dollar for dollar. It doesn't reduce your tax dollar for dollar.
Right, but it's a dollar for dollar write-off.
Correct.
Yeah,
Absolutely.
Yeah, okay.
Yeah. But you do need to tell your tax person, because in the past, it does not say qualified charitable distribution on your 1099-R. Okay. So if you give that to your tax person, it's not, unless their crystal ball is working that day, they will not know.
Yeah. So a couple other kind of mistakes or things that come up are missed required minimum distributions. And that doesn't happen if you're a client here, but if you have an outside IRA or an account that we're not managing. So we've brought on a new client last year and had to help them, and Rachel navigated through that with them.
There's a 25% penalty if you miss your required minimum distribution. So you definitely want to make sure you're working with an advisor that knows what they're doing. And if you did miss it, you can file a waiver to waive the penalty.
And then, but that doesn't mean you still didn't have to take all those missed required minimum distributions, and perhaps you may have to take it in the year that all in 1 year.
And you can't do a qualified charitable distribution for the missed years, only on the current year.
Yep. And then sometimes there's confusion about when. So I know it's changed a lot. It used to be 70 and a half, and then it went to 72, and now it's 73. Down the line, it'll be 75, but for right now, it's 73. And so if the year that you turn 73, you can take it that year, or you can take it the following year, but you have to take it by April 1st of the following year. And then that year, you still have to take your age 74 RMD or QCD. So then you may have 2 in 1 year. So they're making sure there's different deadlines and there's different reasons why somebody may want to do it all in 1 year versus the other. But it just, once again, there's a little bit of planning involved there. And then another thing is maybe you inherited an IRA you don't know about yet. But there are definitely some rules with inherited IRAs and taking money out, depending on if you're a spouse, or you probably know if you're a spouse if you've inherited, or if it's a non-spouse, there's some different rules that are in place.
And with Roth IRAs, you don't have to take a required minimum, but if it's inherited, then you do.
For the
So,
and
it's so tricky.
if they were taking RMDs, it depends on the age of.
Exactly.
Yeah. So there's a lot of different nuances.
Yeah.
Yes. And then, Rachel mentioned, the reporting, so 1099-Rs that went out did not in the past indicate if it was a charitable distribution, and so the tax advisors, if you didn't tell them, they wouldn't know. But going forward,
they're saying
it, but you still want to double check and
yes.
provide that.
Make sure you let your tax person know.
Yes. So, and then the other thing that came up that I saw recently, which is the IRS released, was on Roth catch-ups. So it was supposed to take place in 2024, but it looks like it's going to potentially take place in 2026. But anything can happen between now and then. But what the rule is, basically, it's for those that are contributing to retirement
401ks.
plans and 401k plan accounts, that depending on your income, so if you make more than $145,000 on your prior year W-2, then your catch-up contribution, instead of being pre-tax, would need to go in as a Roth after tax.
Which means your taxes are going to go up.
Yes. And then you have to make sure your plan allows that. Most plans do offer it now, but you have to double check to make sure the plan allows for that. So there are some changes coming our way. Obviously, it makes it a little more interesting, like you said, as you're planning for taxes and if you're used to certain deductions. But more to come.
More to come.
So,
exactly.
Well, I think we covered a lot today, unless there's anything else anybody else would like to add.
It was kind of interesting. You said that about taxes and taxes going up. And Best Secretary of the Treasury was saying that he thinks the 2026, and it's interesting, tax refunds, he thinks for 2026 are going to be significantly larger than 2025. So
sure.
I mean, that's what he said. So I mean,
maybe for low income.
Maybe.
Yeah.
I don't know. He just mentioned it was a blanket statement.
Because there's going to be the senior deduction.
There's the senior deduction. There's the charitable deduction.
Yeah,
but those benefits phase out if your income's over a certain point.
Yeah.
So
and then the SALT, there were some changes.
The state and local tax deduction.
He might have just mentioned something for. I don't know. Anyway,
I don't know. We'll see.
That's what he said.
You know what? We'll talk about it on the podcast in April next year.
There you
go. And the last thing I want to say to investors out there, don't fight the Fed. Because if Catherine's numbers are right and it's 85% potential in October and then another cut in December, typically you're going to see, the market continue to move upward and people are going to be buying any dips. And, for the next 6 to 8 months, it's going to be an upward trend. So, again, don't fight the Fed and, stay invested as best you can.
Well, I think that concludes. If you have any questions or if you like additional information, we're happy to meet with you or have a conversation with you about your own specific situation. And until next time, thank you for joining us.
Thank you.
Thank you.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.